one of the big things that we often like to talk about is how it's important to kind of follow where the big money is going. And I know this is what you've built your whole business on is tracking this information. You had your experience working with Fidelity, and of course, Fidelity has a lot of money that they're dealing with under their belts. So for people that aren't familiar with your method, maybe kind of introduce them to why you find it so important to follow and track the fund movement.
Yeah, thanks so much. Whenever there's a kind of a slower time in the market, I always go back and I always look at some really good reading material. And William O'Neill said it best. So 75% of the movement of the market is large money. It's my old employer and their funds buying particular and selling particular stocks. And William O'Neill in his book said, wouldn't it be nice to know what they're thinking and what they're feeling and what they're worried about? And the reality is that for most of these managers, just globally, that manage billion-dollar funds, they're not particularly on TV, and they usually don't want to be heard from because A, they're incredibly busy doing research with their team, but then also they don't want you to know exactly what they're doing and what they're thinking, and simply because it takes them a really long time to build a position. And then William O'Neill in his book, he shares, I think really important, he gives an example of a $5 billion fund. And that particular fund, in order to build a 2% position, that's somewhat in a mutual fund or in a fund somewhat meaningful, that he uses a $50 price, he wants to take up some of the float, but not all the float. But moral of the story is it takes 22 trading days, almost 2 months, to scoop up as many shares for that fund, assuming no other fund is kind of going there too. And the moral of the story is it moves the price. So
Mhm.
in my personal preference, I want to see institutional sponsorship, and I want to see kind of a big thirst, big share buying. It moves the price. And that's what gets me excited. That's like that investigation that I always want to really figure out.
Right. So now, of course, the way I have always thought of it is kind of if you're getting in rough waters, it's better to have that big ship go in front of you and kind of smooth things out, and you just kind of follow along in their wake. But it's certainly with a bear market, the bear market that we've had. Um, it seems like nothing. Well, I mean, you've had these pockets of strength, not really in the growth area. I mean, again, we mentioned how energy and a lot of the cyclicals you're seeing strength in there. But how much do you have to worry about the funds moving too quickly? Sometimes it's like, oh, they had to move out of growth and into cyclicals, or when you start to see some bottoming action, do they ditch the cyclicals and ditch the defensive plays like the Hershey's and Coca-Colas and Pepsi's to get back into growth? How quickly does that happen? Is it truly like a 22 day thing, or can it happen in a shorter time frame?
I typically see it happen, especially with big, large stocks, large caps to kind of mega caps. It takes even longer than 2 months. If you were to go to the slide that shares the 12-month, so one thing that I wanted to share, what I think is really interesting, especially in this kind of bear market, because it really almost started in 2021, especially with small caps and growth stocks. It's when I looked at these are particular stocks that saw 12 months of consistent selling month over month over month. And how I'll go back to some of the kind of my processes, but I thought this was so interesting. So it happens for a long time. So a really good example is Valero, VLO, 12 straight months. So what I'm simply doing is I'm looking at a little over $1 trillion. It's definitely not the entire marketscape,
Hmm.
but in a very ethical way of getting this data within the last 30 days. So names like Valero up 58% year to date, Diamondback Energy, FANG, up 34%, Royalty Pharma up a whopping 5% RPRX, and CoStar, which is like financial data for real estate companies,
Hmm.
CSGP up 2%. So for some of the names, they're actually accumulating consistently over 12 months or more.
Hmm. So with some of those like Royalty Pharma and CoStar, what's your explanation there? If they've been accumulating for that long. Why haven't we seen that in their price performance?
It's a really good example. So the names I'm sharing with you are the most consistent list. They're not the
Hmm.
biggest list. So these are
Okay.
all have been on my radar. A good example of way bigger would have been ExxonMobil
Hmm.
and Conoco, which have well better performance than Valero. But they're just buying small, they're just chipping in. So it's just not massively large, but those are the four names that no matter what, net buying, that's been there for 12 months. So it's not the largest, they're not the largest share increases, but they've been there. But I think on the contra side, who's been selling, and I think Bill O'Neill also covers this really well. And he says, as much as they don't want you to know what they're buying, they absolutely don't want you to know what they're selling.
Right.
And when he says that very simply is once kind of the cat's out of the bag of what they're selling, then other people sell so they can get out before the larger funds can get out.
Hmm.
And if you go back to, it's the slide that has the pictures with Salesforce.com is one example of a stock that's just seen 12 months of consecutive selling. It's down 48% year to date. NVIDIA, an incredible semiconductor name, down 46. Google down 33 and Microsoft down 27. So in my experience of kind of scraping this data, I just think it's such a big difference. And this is what they've been letting go of. And a lot of these names have had large selling and impact selling. And they've just obviously seen it in their price movement.
Hmm. Now, a lot of these, I mean, Alphabet, Microsoft, Nvidia, I mean, these were and Salesforce, these were all kind of mutual fund darlings. I mean, they were owned by a lot of funds. It almost seemed at a certain point who was left to buy because all of the funds owned a good portion of them. A lot of them had to just because by nature of them being larger companies and having such heavy weights in the indexes, the Nasdaq Composite or S&P 500, take your pick. They kind of had to own them, because if they didn't, they could easily lose performance versus the index by venturing away from those because their market weights were so heavy. So, does this mean that these are done? Do you think, or is this just something that's temporary?
That's a really good question. The answer is they're done for now. So
Hmm.
I would just say that they have been deploying capital to other names. And these are great companies. And at some point, they're going to move from their growth benchmarks to their value benchmarks. But you're absolutely right. Index hugging is real. It's everyone wants their bonus and everyone
Hmm.
wants to have good catch up trades. I wanted to share with listeners the last 3 months because I think that'll kind of help to determine a little bit more of what I've seen. And what I'm looking for specifically are 3 months of consecutive buying and three
Hmm.
months of consecutive selling. But this is the largest dollars that I've seen. So this is like big buying and big selling. And I think the first thing that sticks out to me is one of William O'Neill's quotes in regards to mutual funds and hedge funds and these private funds. They will get things wrong, but they're
Yeah.
not going to tell you, but you can kind of see it a little bit too. So as an example, they don't get everything right. So Amazon was a very large purchase over the last 3 months, and it's been wrong, and the chart is ugly, but they
Hmm.
have gotten things right like Oracle and Cigna and DR Horton and Netflix. And for some reason, they like Snapchat the last 3 months, which is really interesting because it's done absolutely nothing and just been a horrible investment. But Enphase is on there with growth stocks, and Conoco's now a growth stock, was a value stock. And on the contrary, you've seen other names like Apple and Microsoft and Google, and all those ones are being let go of. But again, they're not perfect. As an example, Horizon Therapeutics went from 70 to 100 back down to 70 and just got bought out. So
Right.
there's going to be names on both sides where they can't get them all right. But I think the most fascinating thing is that you'd expect during a bear market bounce that things that got hit the hardest to recover quicker. And what's
Hmm.
really interesting is the names in which they're buying still outperformed since September by it's only 1 percentage point, but the things that they have been still letting go of. So you can kind of see the difference between what they're adding and what they're subtracting. And I just think
Hmm.
it's so interesting of where is this big money going even during tough times.
Hmm. Now, one of the things that I guess a lot of people are probably wondering is, okay, you're looking at this data, and I mean, even though $1 trillion is not a small amount of money, a trillion here, a trillion there, you start talking about some big numbers, right? Um, how much of the market is this, and can you make logical assumptions, kind of with a sample size of a trillion or so, to the larger market and what the majority of funds are doing?
It's a really good question. So the answer is it. I think from my memory, I think the overall U.S. stock market's around 36 trillion is my assumption based upon a study a while ago. So the answer is it's a small piece. But what I'm specifically looking for is large dollars, large share increases, and it's large enough where it actually moves the price.
Hmm.
So a good example is what we all have access to are 13F reports. And 13F reports, they came out at the end of September. You kind of like, we took a snapshot, and that was delivered on November 15th, 45 days later. And everyone got their, looked at the newspaper, and they saw Warren Buffett bought Taiwan Semiconductor, and everyone
Right.
saw it. And what I'm simply doing is there is data out there. It's ethical, it's legal,
Hmm.
and I think if everyone else had an extra 20 to 40 hours more back in their life, they could figure this out too. Very simply with Invest with Rules, I'm giving it's 30 days later. So in comparison to the 13F, it's 15 days before the last 13F report.
Hmm.
And and then the other one, we're gonna get another one, another 13F report as of the end of December this month. On the I think it's the 30th is the final day of the year, and then we're gonna get that in February. But the beauty of this kind of data collection is we're going to get 3 additional reports
Hmm.
before that 13F report. So the answer to your question is it's not everything, but again, just like how William O'Neill said, this is just one fund, and this one fund can push up the price. And what I'm looking at are dozens upon dozens of funds. And even though it's only a trillion, it does make a difference.
Hmm. And let's talk a little bit about that lag. I mean, you already addressed it to a certain degree because, of course, these funds can't move that quickly. When they're building a position, it takes them days, months in order to build that position. But some people would say, well, gosh, if you've got a lag, from the 13F reports, or what have you, of days, it feels like right now, the way the market's been acting, and part of this is because of headlines. Sometimes the trends aren't lasting more than a week or so. You get a few days up, and then you lose all of the ground, like what we saw from Wednesday's move after Powell's comments to yesterday. All of the gains disappear. So I guess talk about time frame, because you mentioned short term versus long term. Um, what kind of time frame is this relevant for?
Great question. So how I compartmentalize this is the $1 billion fund manager reports and all the data is incredibly important, but it's just step one. And step two is I'm looking for consistency. And then I run it through the trend roadmap. And if you're able to go to the slide with um, O'Reilly Auto Parts, it's an example. So I received a ton of uptrends in early October. So
Hmm.
it was kind of at this earlier juncture where more recently, you're absolutely right. You cannot buy extended. Anything you purchased recently really hasn't been working. We're at the top of this bear market rally. But here's an example of O'Reilly Auto Parts, ORLY. Um, Within the Invest with Rules program, I bought it on October 3rd. It was at $711. I saw 7 months of consecutive $1 billion fund manager buying. I run it next through the trend roadmap because I want to identify trends kind of within the base. And it was in an uptrend, and so it was purchased. It's still being held. It is pulling back, so I think it's up somewhere in the neighborhood, a little over 20%, pulling back. But as of right now, all I've done following rules, the very final step is it's gone up 20%. I lift my stop price. So my stop price is at a positive 10%, and I'm watching it close, but I'm playing with gains. So having these earlier alerts is what drastically helped this process.
Hmm. So Okay, a lot of that is on the technical side. You know, it's certainly the iron can slim, right? The institutional part and the fundamental side. But let's talk a little bit about the fundamental side. How much weight are you putting on those fundamentals? I mean, O'Reilly's not bad. It's, you know, it's got an EPS rating of 93. The composite rating is 98, so it's got a nice collection of things. But it seems like for a lot of stocks out there right now, the earnings are not great, and the estimates are even worse. So certainly with O'Reilly, you can kind of understand recession fears. You know, people are might not be thinking that they're going to be going out and buying new cars, but they're going to be slapping band-aids on their old ones. But talk to me a little bit about that fundamental side.
Yeah, it's really straightforward. As much as I had some accounting background
Hmm.
and I know how to model a stock, the I in Cancelim, I prefer to take it's all data, it's not opinion. I want these funds to do that for me. So
Hmm.
I personally don't. I do look at the ratings from IBD just to see if something's drastically wrong. But in general, all that fundamental work are done by the funds and by their accumulation. And I think another area of the market where that has done well this year that has very little to no earnings are areas like biotech,
Right.
where they've done extraordinarily well and they have some ugly numbers on a lot of them.
Yeah.
So I think it's a really hard market, but I think it still can be found where the numbers can still look good and the funds tip me off.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.